Welcome back to Today Assets Report, your premier source for the most urgent updates in the world of digital finance and cryptocurrency. Today, we are diving deep into a developing situation that has sent shockwaves through the XRP community, leaving many long-term holders questioning their positions as a massive problem surfaces on the horizon. This isn't just your typical market volatility or another round of social media FUD. We are looking at a convergence of on-chain data and institutional shifts that suggest a major hurdle for XRP's immediate price action. As we stand here in February 2026, the landscape for Ripple and its native token has transformed significantly since the legal resolutions of last year, but new challenges are proving that the road to mass adoption is far more treacherous than many anticipated. We've seen a staggering spike in realized losses totaling nearly $2 billion in a single week, which signals a level of capitulation we haven't witnessed since the darkest days of 2022. This massive exit by retail investors is creating a vacuum of confidence that even the most bullish institutional news is struggling to fill. And if you're holding XRP right now, you absolutely need to understand the mechanics behind this shift before the next candle closes. The core of this problem lies in a dramatic disconnect between the underlying utility of the XRP ledger and the actual market performance of the token itself. While Ripple has been aggressively building out its institutional infrastructure, spending billions on acquisitions to create a comprehensive financial stack, the retail market is feeling the heavy weight of a sell-the-news cycle that has turned into a prolonged correction. Many investors expected that once the SEC lawsuit was finally settled and the appeals were withdrawn in August 2025, the price would move into a permanent upward trajectory. Instead, what we've seen is a classic case of market exhaustion, where the regulatory clarity actually stripped away the speculative courtroom hype that had been a major price driver for years. Now that XRP is being judged solely on its merit and adoption rates, the reality of slow-moving banking integrations is hitting home, and the massive problem is that the market is currently repricing XRP not as a speculative moonshot, but as a utility asset that still has a very long way to go to justify its previous peaks. What makes this situation particularly alarming for the average holder is the sheer volume of selling pressure coming from those who have held through years of litigation only to see their portfolios dwindle in the post-settlement era. According to the latest on-chain analytics from Santiment, the surge in realized losses indicates that even the most diamond-handed supporters are finally throwing in the towel, often selling at a loss to rotate into other ecosystems that are showing more immediate momentum. This capitulation event is a double-edged sword. While it historically can signal a market bottom, the current macro environment and the specific structural headwinds facing Ripple make this time feel different. We are seeing XRP lose ground against its major competitors like Solana and Ethereum, which have built more robust, decentralized finance ecosystems. The massive problem here is that while XRP was locked in a legal battle, the rest of the crypto world moved on to build lending protocols, smart contract layers, and high-velocity trading platforms that the XRP ledger is only just beginning to implement. Furthermore, we have to talk about the supply-side dynamics that are currently acting as a massive anchor on the price of XRP. Even with the legal cloud removed, the monthly escrow releases from Ripple continue to inject hundreds of millions of tokens into the potential circulating supply. In a market where demand isn't scaling at the same rate, this persistent dilution is a structural problem that other major assets like Bitcoin simply don't have to face. When you combine these scheduled unlocks with the recent sell-off from major whales who are rebalancing their portfolios for the 2026 fiscal year, the result is a mountain of sell pressure that requires billions of dollars in new capital just to maintain current price levels. This is the bad part of the headline that many don't want to hear. The math of the supply and demand curve is currently working against a rapid recovery, and the influx of institutional capital through the new spot ETFs hasn't been enough to offset the tide of retail liquidation and escrow inflation. Another layer to this massive problem is the technical state of the network's activity, which recently saw a terrifying 99% drop in transaction volume over a short period. While some developers have pointed toward weekend liquidity shifts and institutional downtime as the cause, The optics of such a massive decline in usage are devastating for investor sentiment. In a world where network effect is everything, seeing the XRP ledger's payment volume plummet from over $1 billion to just a fraction of that in 48 hours raises serious questions about the consistency of its enterprise adoption. If the ledger is meant to be the future of global payments, these gaps in activity suggest that the transition from Swift to RippleNet is happening in fits and starts rather than a steady stream. For holders, this means the utility argument is being tested in real time, and right now, the data is providing more questions than answers, leading to the fear that the network might be underutilized compared to its massive valuation. Let's look at the institutional side of things, because even there, we are seeing a good news, bad news scenario. Yes, we have 7-spot XRP ETFs now trading, and companies like Franklin Templeton and Grayscale are bringing XRP to the desks of thousands of financial advisors. However, the initial rush of ETF mania has cooled significantly, with assets under management in these funds seeing a 40% decline alongside the spot price. This tells us that institutional investors are not immune to the same fears affecting the retail market. They are also de-risking and waiting for a clearer sign of a bottom. The massive problem is that if these big money players continue to see XRP underperform compared to the broader market, their sticky capital might not be as permanent as we hoped. We are essentially in a race against time where Ripple needs to show significant, undeniable banking adoption before the institutional interest completely evaporates into the next big narrative like AI-integrated tokens or modular blockchains. The competitive landscape has also become a massive problem for XRP's core value proposition as a bridge currency. The rise of stablecoins, including Ripple's own RLUSD and the euro-backed tokens being launched by major banks on the XRPL, is a bit of a catch-22. While these stablecoins bring volume to the ledger, they also provide a way for banks to settle transactions without ever needing to hold or use XRP as a bridge. If a bank can move value using a dollar-pegged stablecoin with high liquidity, the necessity for a volatile asset like XRP to act as the intermediary starts to diminish. This is a fundamental challenge to the XRP as a bridge thesis that has been the cornerstone of the community's hope for years. If the ledger succeeds, but the token isn't required for that success, holders are left with an asset that lacks the necessary demand drivers to reach those legendary price targets we all hear about. We also have to address the death cross and the bearish technical patterns that are currently dominating the charts. For the technical analysts among us, seeing XRP slip below its 200-day moving average while forming lower highs is a major red flag that suggests more downside could be on the way. The support levels at 130 and 125 are currently under heavy fire, and a break below those could lead to a deeper retracement toward the 115 mark. This technical weakness is feeding into the psychological massive problem for holders because it creates a self-fulfilling prophecy of selling. When investors see the price failing to reclaim key resistance zones like 145, they lose hope and sell, which further drives the price down. It's a vicious cycle that requires a massive positive catalyst to break, and as of this moment in February 2026, the calendar for such a catalyst looks surprisingly thin until we get further into the second quarter. Now, it isn't all doom and gloom, but we have to stay grounded in the reality of the current bad situation. There are developments like the upcoming institutional lending protocols and the integration of tokenized commodities that could eventually turn the tide, but these are long-term plays that won't fix the immediate liquidity crisis or the sentiment problem. The transition to a new, independent XRP Ledger Foundation is also a positive step for decentralization, but in the short term, it creates operational noise and uncertainty that markets generally dislike. Holders are essentially being asked to wait even longer after already waiting years for a legal resolution that didn't deliver the immediate results promised by many influencers. This exhaustion factor is a massive problem because a community can only stay energized for so long without seeing positive price action, and we are reaching a breaking point for many veteran XRP investors. We should also consider the broader macroeconomic environment, which has not been kind to high beta assets lately. With a crypto-wide drawdown wiping out trillions in market value, XRP is fighting an uphill battle against a global trend of de-risking. The problem is that while Bitcoin is being viewed more as a digital gold hedge and Ethereum is the world computer, XRP is still struggling to define its role in a portfolio for the average institutional investor. If it's not a store of value and it's not the primary DeFi hub, it has to be the undisputed king of payments. But with the competition from CBDCs and private bank-led blockchain networks, that crown is being challenged like never before. This lack of a clear, uncontested win in the payment space is a massive problem for the token's long-term valuation model, especially as we look toward the 2027 and 2028 projections. The sentiment in the Binance Square and other social hubs for XRP has shifted from "when moon" to "why is this happening?" And that change in tone is perhaps the most telling indicator of the massive problem we are facing. When the most loyal community members start posting about their realized losses and questioning the utility of the bridge currency, it creates a ripple effect, pun intended, that discourages new capital from entering the space. We are seeing a liquidity desert where buyers are stepping back to see how low the price can go, and sellers are being forced out by margin calls or pure frustration. This is a dangerous phase for any asset, as it can lead to a flush out, where the price drops far lower than the fundamentals would suggest, simply because there's no one left to buy the dip. It's also important to note that the high-profile price targets from major banks like Standard Chartered have been slashed recently, which has acted as another blow to holder confidence. Seeing an $8.00 price target for 2026 get revised down to $2.80 is a sobering reminder that even the biggest analysts are having to account for the slower-than-expected pace of crypto banking integration. While $2.80 would still be a double from today's prices, the psychological impact of losing that all-time high target in the near term is significant. It changes the narrative from generational wealth to moderate recovery. And for many who bought in near the top of the 2025 spikes, a moderate recovery still leaves them in the red. This reality is a massive problem for the collective morale of the XRP army. Furthermore, the massive problem extends to the developer ecosystem. While sidechains are being introduced to bring smart contracts to XRP, the developer mindshare is still heavily concentrated on Solana and Ethereum's Layer 2s. Without a vibrant ecosystem of apps, games, and NFT platforms, the XRP ledger remains a bit of a ghost town compared to its rivals. This lack of organic daily retail usage means that the price of XRP is entirely dependent on big bank announcements, which are notoriously slow to materialize and often involve pilot programs that don't actually use the token. For a holder, being dependent on the bureaucracy of global banking is a frustrating and often losing game in the fast-paced world of crypto. So, where does this leave us? The situation is undeniably bad for those looking for a quick turnaround, and the massive problems we've discussed, from on-chain capitulation to competitive bridge solutions, are real hurdles that can't be ignored. The Today Assets Report team is keeping a close eye on the $1.30 support level as a daily close below that could confirm the worst-case scenarios for the coming weeks. We are in a period of extreme testing for XRP holders, and the decisions made in the next few days could define your portfolio's performance for the rest of 2026. This isn't the time for blind optimism. It's the time for a cold, hard look at the data and a strategic assessment of your risk tolerance in a market that has become increasingly unforgiving. As we wrap up this urgent news segment, the evidence is clear that XRP is at a major crossroads, and the massive problem isn't just one thing, but a collection of headwinds that have finally converged. From the billion-dollar realized losses to the structural shifts in how banks use the ledger, the old buy and hold playbook is being rewritten in real time. If you found this deep dive into the current XRP crisis helpful, make sure to stay tuned as we continue to track these developments and provide you with the raw, unvarnished truth about your favorite assets. The world of digital finance waits for no one, and being informed is your only defense against the volatility of the 2026 market. Would you like me to do a deep dive analysis into the specific wallets causing this selling pressure to see if the whales are actually leaving the ship?